So we're 1 minute past start time, so I'm going to jump in. I'll introduce myself, James Graham, with Marshberry out of our California office down here in Dana Point. Been with the firm almost a decade now. Prior to Marshberry, I was at Deloitte Consulting, and I sit on our financial advisory team currently. So spend a good amount of my time advising agencies and brokerages on the sale of their business and on other capital strategies related to what their goals are. Today, I'm going to be talking about what it means to sell to a strategic buyer, what that process looks like, what the valuations are, how that decision is arrived to. We'll touch a little bit on some of the different options. If anyone on the call has any questions, this is a picture of me and a little bit of a bio on our website. We'll talk a little bit. We're a trusted advisor for insurance broker and financial services. So some of you, a lot of our clients traditionally have been insurance brokerages. We also work with wealth management firms, retirement service firms, and a lot of insurance intermediaries outside of traditional group health and commercial line insurance and personal lines insurance agencies. If anyone listening to the webinar has questions throughout the time, the chat is open and I can see it. So feel free to chat those questions at me. I will do my best to respond in real time as I'm going through the content. A little update on us. Many of you know us, and we've been in business now for over 40 years. But want to update on us. We're nationwide and global. We have offices across the U.S. in California, Texas, Ohio, Michigan, Virginia, and New York. And we have professional colleagues in many other states. And then we have offices in the Netherlands and the UK. So global firm advising agencies and brokers in both the US and Europe and in other global markets as opportunities come up. Over 200 employees today, currently backed by a private equity firm, Atlas Merchant Capital. The goal of what we do and our bias and the way that we market and work with our clients is the baseline is market intelligence, is learning and understanding their business, educating them on how to make their business better, how does their business perform, how does it compare. Many of you are familiar with our PHP benchmarking services or subscribing to that service. And that is the core of how this company started and the core of how we do everything. We're a very data-driven company, and we lead with data in everything that we do. We lead with facts. So it's educating clients on how to better run their firms and informing that with real data from the market. And then it's how do they improve it? So once they learn about their firm and how is it performing and how does it look towards other brokerages and what does the market look like to improve and what are the best practices, then it's how do they make it better? And we have a number of consulting services around improving the value of your firm. And I'll say value creation is again, that's what we do. And that's our bias. You may talk to a CPA, their bias is to help you avoid taxes. Our bias is to help you increase the value of your firm. That you talk to an HR professional consulting firm, they're going to help you stay out of EPLI litigation. So our bias is how do you make your firm more valuable? So all our consulting services are around that, right? And so they are tailored towards what are the number one challenges that clients have communicated to us over the last 40 years when it comes to improving the value based on what they've learned from our data and analytics services. And then finally, in the investment banking team, which I spend the majority of my time on, we help firms realize the value. And there's a number of different ways that they can do that. They can sell to a strategic buyer, which we're talking about today. They might need help buying firms to increase the value. They might need debt to solve shareholder problems, do a deal, make investments in new hires, and we help with debt raises. They might decide they want to sell part of the firm, and we'll talk about a little bit on equity capital. And there's all sorts of other ways that we can help firms with their capital structure to allow them to accomplish their goals. We are the number one sell-side advisory firm in the industry. We can talk through, so there's just some stats here, is how many transactions that we do and our presence in depth. We have the largest database of offers in the industry and data terms. No one has what we have as far as data warehousing and data benchmarking at the click of a button. So talking about selling to a strategic buyer, it's important to talk about sort of how we see the world when it comes to what decisions management and shareholders of an agency and broker can make as they try to make the decision on should they sell to a strategic buyer and what would that mean for them. What we have is, we call this the 7 paths. Essentially, at any given point in an agency's life cycle, they're going to be making a decision on what they do with their equity. And no one can take it with them. When you pass, the equity's got to go somewhere. And so you want to be thoughtful about how that equity transitions and how you use it to grow, how you increase its value. And there's different competing desires that the owners will have that will lead them down different roads. And those could be sell to strategic. They might be very committed to an internal perpetuation plan. A lot of our clients are and remain independent for generations and are able to do that. They might decide that because of the way that they're mixed their businesses, it's right to do some sort of an ESOP, which we've been able to find ways to make that not the same discount that has been historically by using some unique structures to do that to generate higher value than internal perpetuation. And Marshberry did that for ourselves for a period of time. We were in ESOP for about 5 years before we took on the next one, the equity partner, and now we're 50% owned by an equity partner. So this is another way to solve some of the capital needs that an agency may have for investment or hiring shareholders or providing liquidity to the company for growth. You can use debt as part of all of this. So debt's not a separate strategy. It's an underlying strategy to all of these things. If you're internally perpetuating, you have an ESOP or you bring on an equity partner, there's likely going to be some debt involved, including if you do a broker formation, you decide to band together with a number of firms to build a larger national model or regional model, then debt was likely to be a part of that as well. We're very involved with the debt capital markets. We understand how lenders view the insurance space and how to drive terms there. It's actually less commodified than people might expect it to be. And that's true for all of these things. I think there's a general misconception that these decisions can be made and that an agency owner can grab publicly available information, have some understanding of how to drive deal points and terms that are fair, but that's not the case. There's only probably a handful of advisors in the space. We have the most data that have all the information to be able to drive the best terms for our clients, whatever direction they decide to go. And then ultimately, as a backdrop to all of this, commitment to the high organic growth increases optionality for firms and allows them to get better terms with all of these particular paths and should be sort of the baseline goal of any organization. It's not easy, it's work, but we have a lot of tools and resources that we bring to bear to promote this. And we do it ourselves. We're the only advisor in the space that runs a company consistent with the way that we advise our clients to run their companies. So we're actually growing at a 15% organic growth rate on average. And we are doing that with a majority non-reoccurring income. So we understand what it takes and the commitment and the discipline to grow a company consistently year over year and how challenging that is. This next slide, we're talking about, these are the different firms we've supported. So some of you may know these names in the different paths over the years. And some of these firms have done multiple paths. So you'll see Graham and Company, they were an ESOP ICAP product. They did that for a while and they ended up selling strategic at some point. So we'll see multiple iterations. Some of these things are things that will happen one time, multiple times over the life cycle of a company. And the change in the capital structure is a constant thing. There isn't sort of a static capital structure for the long run for anyone. So we'll talk a little bit about the M&A market. And when we think about selling to a strategic buyer, what is going on? So quality of earnings, we were talking about this quality of growth. With the increase in one of the themes is everyone is aware the cost of capital has essentially doubled from 2021 to today with the rise of interest rates. We do believe with the rest of the market that we're hopefully at some sort of peak with cost of capital. But what that has meant is buyers have become more selective, or more buyers have become more selective about how they value firms. And growth matters more than ever. For a seller to have same optionality they would have had in 2020 or 2021, they need to have strong organic growth rates. And printing a 10% CAGR over a 5-year period is a way to differentiate yourself from the market and drive higher valuations and more options for partners than if you're below that number. There are obviously exceptions. Every deal's not a commodity. There are nuances, but growth has mattered more than it has over the prior to the interest rate hiking cycle. We have seen a reduction in deals, and we'll show that in a minute, as some firms went on the sidelines and capital costs went higher. We'll talk about how that is talked about, but we do see it picking back up. This year is the year of the hellacious earnouts. 2021 was the most active year on record, and the average earnout period is 3 years. So a large number of very active acquirers have very large earnout obligations that are due in 2024. Some of them will be payable in 2025, but earned in 2024. It's gonna be a lot to get through that. But we do hope that if the buyers continue to grow, and continue to print strong returns, that they're gonna, as they clear out those earnouts, they're gonna have capacity to continue to get more aggressive, and they're gonna be seeking to fill their pipelines for new partnerships. We've also seen a move away from the pure decentralization market for firms. Many of you are aware that Acrisure went around about a lot of firms with the promise that they would never integrate, and now they are integrating and changing names and moving away from the never touch you, never integrate you model. So what we see in the market now is the private equity community is sort of demanding some level of integration. So you can still have a decent amount of autonomy as a seller into a broker with the right partner, but there will be financial integration, there will be HR integration, there'll be IT integration. And so finding the right mix of integration is more of the conversation now. And sellers are much more interested in what a buyer brings to them rather than just a check. The market has gotten a little more difficult to operate in, from especially on the property side and the talent side. And so sellers are often not just asking, okay, they're not just looking for a check and to be left alone. They want help, they want resources, they want certain pain points to be alleviated, and they're looking for a partner that does that in a way that doesn't mess with the things or doesn't disrupt the things that they care about the most in running their business. The industry continues to consolidate, but what you do see is an increase of large brokers. So over 10 million in revenue, we're seeing a pickup of that. There's two things going on there. One, as firms consolidate and deals are done, you have more platforms, whether it be regional or national, that are forming and that are homes for different types of niches and agencies. And the premium market, the hardening market, has led to immense growth, even for firms that are just renewing their accounts. And we'll talk about organic growth in a minute. What you do see is on the small end, most of the consolidation is happening in those sort of small, very local agencies, sort of under 5 million in commission. That's where you see the most of the consolidation taking place. The one interesting point, there's been over 7,000 deals done over the last, over an 11-year period from 2011 to 22, but only a decrease of 1,500 firms, which just shows you how much growth has happened in the marketplace. The market has gotten substantially larger, and the fact that it constantly recedes, there's new firms on a regular basis, there's new risks to be serviced. And we've seen a lot, I don't have a slide on this, but many of you are aware, large growth in the excess surplus market that has led to lots of new entrants into different parts of the market to serve underserved areas as the market's been more difficult on the property side. So landscape is becoming more certain. And I don't know if that's not something that's hard to say, but essentially we feel like inflation is under control. The economy's got strong growth rate. Labor market is in balance for the most part. Unemployment remains low, but it has ticked up a little bit. Geopolitical environment, although uncertain, seems to be okay for the U.S. The extreme weather losses, we understand those. That's been affecting things massively on the rate side. Leverage ratios have come in line a little bit more for a lot of the buyers. They've brought those down slightly. And they have plenty of access to debt, which is a key thing. Then we talk about the premium rate environment has caused a lot of natural organic growth. So things right now in 24 are materially better than they were in 23 from a risk appetite perspective of the buyer community. There are more options, and the bid is a little bit more frenzied than last year. U.S. broker EBITDA as a percent of net revenue, you see the increase over time in our data set by a few percentage points. And the point here is to show that in and out of rate hiking cycles, margins stay similar. And one of the reasons why we do see some margin expansion over the last few years is organic growth rates are up overall. I think we're seeing average organic growth rates in the 8% range, which is sort of double the long-term average organic growth. Insurance distribution deals by buyer. In the market, this story has been consistent now since 2008. Private equity is driving most of the transactions. We do see a consistent and strong demand from the publics. You think Gallagher, Brown & Brown, Aon, bought NFP, people know about that very public transaction. MMA is very active through their middle market brand. And so you see kind of what's going on. Banks and thrifts was very large buyer prior to 2008. We've actually seen them divest more than they bought for the first time over the last sort of 24 months as they seek to raise capital, given the interest rate environment on a lot of the assets that they held going backwards. So the story hasn't changed for a long time. Private equity is driving it. You see the decline in deals. That's driven by a little less market interest. Also, 2021, when I say demand, a couple of buyers obviously took a sidelines in 2022 and 2023. Also, 2021, a record number of deals happened because there was a scare on taxes going up, and sellers elected to lock in the historically low tax rates in 2021 and not take the risk. Now, ultimately, those taxes didn't go up. We're back into another election year this year, and the taxes are back on the table. So that's a very big conversation about owners looking to capitalize on the value of their firms. Depending on what happens in the election, depending on what things happen in Congress, taxes are likely to go up sort of regardless. We just don't know what the rate is. And the reason why we say regardless is the most recent tax cut from 2017 sunsets at the end of 2025. So if nothing happens, tax rates are going up, and there will be proposals that are more aggressive depending on who controls in Washington. So we expect to see a similar rush maybe in 2025 related to the political risk, depending on how things go and what gets proposed over the next number of months. Who are the buyers year to date that are driving the market? This top 10 changes on year to year and on who's being aggressive and who's not being aggressive so far this year. Broad Street has been consistently printing very high numbers of acquisitions. A lot of this is their decentralized model where they have local firms in different markets that are their platforms that are then doing a lot of smaller transactions. So Broad Street corporate company is not doing 16 transactions. Their partners that they have investments in have done 16 transactions. You see Hub, they've been a consistent top buyer over the last, this entire run up since 2008. You see Integrity, who's a little bit of a newer buyer, more in the Medicare and life insurance side than on the P&C and group health side. InZone, which is more in the sort of Main Street business market and personal line side. And then, Gallagher, which publicly traded on all markets. Ascension is rebranded for strategies. Keystone is a cluster that is looking to deploy capital within its membership. Levitt runs a similar model to Broad Street on a smaller, more local level and more rural areas. World Insurance, largely out of the Northeast, has been very active and remains to be very active. And then Alliant, which is more selective on their transactions. So we'll see if they stay in the top 10 over the next 12 months. They're not typically a large volume acquirer. This is interesting to see because you kind of see the trend. This is the trend of who are the top 10 buyers from 2015 through 2024 year to date. And you can see how it sort of changes. You see Acrisure was the top buyer overall, but deal volume fell off a cliff as they sort of moved their strategy from acquisition mode to integration mode in 2022. And that's very obvious by 60 deals in 2022 to 16 in 2023. You can see Broad Street's been consistent. Again, they do it through their platforms. So it's not one entity doing those transactions. As I mentioned, Hub's been a consistent player. You can see AssuredPartners, similar to Acrisure, major slowdown in their acquisition strategy as they seek to reshuffle the cards a little bit in their strategy. You see, where does the volume go? I mean, Gallagher picked up a lot of it in 2023. You see a large increase from 19 to 32. Alaris slowed down a little bit. Again, another private equity-backed firm. that wanted to make sure they were being very selective and thoughtful in as interest rates went up. And so you can see that manifest in their deal count slowing. Again, they have plenty of capital. They're very active, but you do see more selection. World did not slow down in 2023. They were one of the firms that kept going strong. See Integrity, which this entire market, the Medicare life insurance, BGA roll-up part of the market is actually a separate set of players in general. And if anyone has questions on that market, I'm happy to take a call and talk about it. There are a whole other set of players that compete with Integrity for that market share, and you can see how active they've been. And then you see PRC4, another one that came out of the gate very hot, that slowed down with the rise in interest rates. And then Help Group, you see, has been pretty consistent. So this is interesting to show just how buyers come in and out, their strategies change, and they can be aggressive one year and not aggressive another year. And Acrisure might be back next year. I'm not going to have a crystal ball on where they're at on their strategy, but things change year to year, and that's why it's important to stay in touch with individuals like us or firms like us, because we always know what's going on in real time, and lots of reputations that were earned in the past may not be true today. This is more detail about the types of buyers, and you can see, and this is just showing the numbers in raw. The number of total deals over the last 5 years have increased by 1.5%. Total deal CAGRs of 10 years is 9.6%. So you can see deal volume is really up substantially in a decade, but you see a little bit of slowing in 22 and 2023, again, driven by the high cost of capital. And I think I said this earlier, but I want to reiterate, we do think 2024 will show a number higher than 2023 as far as total activity. We think it'll be closer to 2022, and then we think 2025 is going to be similar to 2021. So we're back on the upstroke as far as deal activity in the marketplace. With the cost of capital increases, many of you are probably familiar with horror stories or parts of the market that slowed down substantially from an M&A activity perspective. Insurance brokerage again outperformed other industries as far as returns during this capital tightening cycle, and M&A activity in this capital tightening cycle. So it continues to prove the thesis that it is a very stable investment in good and bad times. I want to talk a little bit about buyer selection and how we work with our clients to help make that decision. And there's lots of lenses that we use. We're big believers that cultural fit overall, based on what a seller is looking for in a partner, drives valuation. So we don't believe that when you work with management-led companies that own all the stocks, the management owns the stock, they're going to have to work with the partner, and they're going to have a good quality of life with the partner, that running a pure auction and just trying to get the highest bid in an impersonal way is the best way to run a process. We believe really understanding what management wants and then matching that with our relationship with all 60 plus well-capitalized buyers is a way to ensure that we actually drive the highest valuation for our clients, rather than not building that relationship through the process like a more traditional investment bank might. And one of the lenses we use is this sort of 4x4 matrix, where we talk about, in general, as you get more from a buyer, more service and structure, you're going to give up operational autonomy. The more they provide in resources, the less decision-making power you're going to have post-closing. And the less they provide, the more autonomy. And that's a general thing to think about. The challenge is when you have firms that don't provide a lot of support and structure, and they also take away a lot of autonomy. If they're in the bottom right quadrant, that's not necessarily a great buyer for most of our clients. But you may also have firms that provide a lot, but they don't take away that much control, and so they're in the upper left, and that might be more attractive on average to our clients. So while we're never going to put buyer logos on this particular slide, we do help our clients think through, what do they want out of a transaction from a buyer? What do they need to make it worth their while, not just from a financial perspective, but operational and life after the deal perspective, and how do different buyers in their market line up with their desires? It's also important to state that many of the large acquirers are national and global firms, and what it means to be a part of that firm varies by market. And one of the things that we help our clients understand is, what does it mean to join them in individual market? Who are the local leaders? How do other people that have sold to them, what do they tell us about what that means? Are they happy? And we give that feedback to all of our clients as they're making the decision on who to partner with. So everyone's favorite section, what are the valuations? What does it look like today? So enterprise value as a multiple of EBITDA, if you focus on the base purchase price, that is, the valuations have essentially doubled since 2008, 2009. And that was a little bit down, obviously, as the recession, but essentially doubled from 5.5 to 10.8 in 2023. It's important to notice that even with the rise of the cost of capital that we experienced in 22, 23, valuations plateaued. They did not go down. So we didn't see material increases in value. The slight increase in 2023 is more of a sample selection phenomenon than a real increase in pricing. We are seeing increased demand in 2024 over 2023, and I wouldn't be shocked if we print a slightly higher average in 2024 over 2023, but it's a little too early to tell. We still believe we're sort of in a plateaued environment currently with valuations, but again, at a all-time record high of the industry over its entire existence. Maximum averages of 14.8, with a realistic being somewhere around 12.25. And realistic growth rates are us taking the earnout of the buyer, assuming historical growth rate of the client, and assuming that works out. Many of our clients are outperforming the realistic, but we want to have a conservative view on there, so you can understand the differences. It's also important to note this is the average EBITDA multiple. There are firms out there that are worth 5 times EBITDA. They're not well run. They have a very risky line of business. I don't know that we have any in this particular data set, but there are firms that they're not worth that much because of the way the business operates, or the underlying type of insurance that they're writing is a low retention line of insurance. It's got a lot of issues with it, high risk, and so that's going to be a less valuable insurance agency. There are brokerages that are going to get in the mid-teens, all the way up to 14 times down, depending on the characteristics of that firm. So if you're a large regional, player north of 20 million in revenue with strong organic growth, getting something north of 14 times down is not uncommon. So average EBITDA multiples are useful to share to help people understand just how much valuations have increased on the average, but individual EBITDA multiples vary widely. And we would need to know a lot more detail to kind of give a client indication what they would be. And EBITDA multiples are only part of the story. Very often we hear EBITDA multiples thrown around as if they're comparable. First of all, when someone quotes an EBITDA multiple, what EBITDA multiple are they quoting? Are they quoting the down payment, the earnout payment? We have buyers that'll put a big multiple at the top of the page, and by the time you get to the bottom, it's not that big. So what EBITDA multiple of what? And then how do they calculate their cash flow? EBITDA multiple of what EBITDA? And how do they calculate that? How was that optimized? What are the risks? What are the risks in the purchase agreement? Knowing an EBITDA multiple is probably more harmful if you think that that's valuable in negotiating your deal than not, because you don't have the whole story without an advisor to help you to really think through it. So just to give you guys an idea on what it means on a revenue multiple basis. So we see 4.15 on a multiple of revenue. This is implied. EBITDA drives everything. And you see that the average revenue multiple in 2008 was 1.5. So just see that material change on the implied revenue multiple. We typically don't see deals priced as a multiple of revenue unless they're small tuck-ins or book rolls, or a fully integrated model where the buyer is going to change everything at closing. How do we know we add value? So I mentioned we believe that fit drives value. We believe that we do everything with leading with data. We have the largest database of deal terms and LOIs of deals that we've worked on and on the sell side represented, and deals that we're aware of because we were involved in some other way and we were able to get the term sheet where we didn't represent the seller. And we're able to benchmark the deals that we represent versus the deals that we didn't represent. And on average, our deals are achieving a 1.10 times multiple of revenue. So this is an implied multiple. And the reason we're using revenue is, like I said before, EBITDA, multiple EBITDA of what? And so the applied revenue multiple kind of gives you a cleaner comparison point of when you take out all the noise, what did you actually get? And on average, our deals are achieving 1.1 times revenue more. So if you're a $20 million revenue firm, that's an additional $20 million in purchase price than if we weren't representing you. And I can assure you, we don't charge $20 million for that extra additional 20 million. So on average, our return on investment calculated, so if you take our fee times the upside, on average is a 973% return. I mentioned we're essentially free when you factor that in. I can tell numerous stories of where I was involved, and as a firm, we were involved, and our clients had existing offers on the table. And on average, my anecdotal experience has been increasing those offers by 30%. Has been a pretty consistent experience of mine working with our clients, and then many times the increases have been quite larger. Obviously, every situation is unique. We have to explore your data. We need to understand your business. And there's also trade-offs. So we really educate our clients on where can they drive value? What does that cost them? Why should they do it? Why might that be risky? And none of our clients are leaving money on the table, at least not without maybe, unless they decide to, because they decide something more valuable than the money in a particular transaction, which is fair, but they're going to make that decision with their eyes wide open. How long does it take to do a deal? So our process takes typically about 6 months. It depends on a couple of things, which I'll talk through. There's a couple of decision points. There's a couple of points where things can go slower or take longer. And there's opportunities, obviously, to go a little bit faster. So we've done deals in 3 months, and we've done deals in a year, all depending on our clients' desires, how long they took to get data, how long it took to make certain decisions. So essentially, once we're engaged, or once an advisor is engaged on average, but our process, once we're engaged, we do a pre-due diligence, which is pretty extensive and very unique. So what we do is we put together a data book and run an internal quality of earnings and put together a SIM in the first 4 to 6 weeks of being retained, that we have a high level of confidence in, that during due diligence, when the buyer hires their advisor, which is a point I should make up, bring up, in a strategic sale, buyers on average, most of the time, are going to hire us or somebody else to review the financials and give them a quality of earnings. So the buyers hire advisors. The buyers do lots of deals. They are expert M&A individuals. The sellers do not do lots of deals. The sellers are not expert M&A professionals and are at a massive disadvantage when negotiating with the buyer. And even in that disadvantage, just with the buyer still hires an advisor to review the financials and calculate EBITDA and help them understand where the risks are. So the buyer is evaluating the advisors. The seller that sells unadvised is materially mismatched and will get a lower valuation and material deal points not in their favor if unadvised. It has consistently been proven in all the data that we can show. So 4 to 6 weeks, we're going to do pre-due diligence. We know how the buyers review these things. We have a high level confidence that the buyers will be able to sign off, assuming no material changes from the time we do the analysis to the time we consummate the deal. So we do all that work. We help position the firm. We help tell the story. And we do all that in the first 4 to 6 weeks. Once the SIM is put together, the quality of earnings on the sell side is put together, we've got a marketing plan. Then we start to put together the marketing plan with our clients. It takes about 1 to 2 months to complete that whole phase. The plan to put together is sort of a week-long process. We go through all the buyers. We interview the partners at the selling agency. We understand what they care about. We match them up against the different parties. We explain what the pros and cons are of each one of the potential acquirers. Then we go to market. We send a teaser out. It's on a no-name basis. We get NDAs in place, and we start to create a market for the asset that we're representing. Then at that point we have buyer meetings. We coach our clients on what they should say in those meetings, on how what things are going to come up, what kind of questions are going to be asked. So our clients walk into those meetings well prepared. After those meetings, we're going to receive offers. We benchmark those offers on apples to apples comparison. There's a lot of terms and conditions and the way things are written that different buyers put in that can be misleading or not clear. And what we do is we take all that out and we put it in a common format so that our clients can review the offers on an apples-to-apples basis and really understand what's being offered and where the risks are and where the things that aren't so clear, how do those things line up. Then we work with our clients on how do they want to improve, who do they like from a cultural standpoint, from a fit perspective, and what are the things they value based on the initial offers. And we go out and we negotiate and we work to drive the best possible value for our client prior to signing a letter of intent. Once the letter of intent's signed, we don't disappear. There's a number of advisors in the space that they'll bring our clients to a letter of intent, they'll get it signed, and then they're just yelling at people trying to get the deal closed. They're not protecting the client's best interest. The buyer will seek, if not held accountable, will seek to drive the valuation lower post LOI. And it's our job as the advisors to maintain or increase the LOI price, which we're often able to do post LOI during due diligence if the facts allow. So we're very highly involved in working with the advisors that the buyer is going to hire to validate the purchase price. We're going to work with the lawyers to ensure that all the legal documents are moved around smoothly, those risks are understood, and that we communicate with the business team if we need to ensure that the legal side moves appropriately. We're going to work with the buyer on employee communication, producer communication, producer buyouts and buy downs. What do the compensation packages look like for key people? So we're very involved in every single deal point and make sure that everything goes as smoothly as humanly possible for the 2 to 3 months prior to closing. And then we continue to support our clients even after the deal closed. Typically, there are earnouts related to these deals. 99% of the time, we're always involved with our clients through the earnouts, ensuring that the deal is being upheld and that we're reviewing the financials. We're helping coach them on how to hit their earnouts. We're there as a strategic advisor throughout the relationship with the future party and happy to get involved and use our relationship to the betterment of our clients anywhere that we can. So our services go through the entire process, and we really believe that differentiates us when a client is looking to find a long-term partner. It's a big deal. If you sell your strategic partner, it's likely to be the only time you sell your business. Some of the other options, you can be part of buying and selling the business multiple times. If you sell to a strategic buyer, hopefully you do find a buyer you want to partner with, and you're not selling out necessarily. You can get some of their equity, and you have a chance to trade that multiple times throughout your career, and that perform hopefully quite well and has historically. That's a whole other conversation to talk through sort of the deal statistics related to equity from the buyer. But this is a big deal. And we understand that, and we value it extremely and honor the fact that it's a big deal and that we need to be involved with every little thing and be there for our clients through every phase of the transaction, pre and post the transaction. So that concludes what does it mean to sell to strategic buyer. I want to summarize a couple key points. The first thing is the market valuations have plateaued. Things are still very strong. We believe fit drives value. We have the most experience on the sell side. It takes 4 to 6 months, and we're involved through the whole thing. So somebody asked a question, want to address question. It'd be good further explain slide 23 without naming a client, share a story, use walk through the arms. So on slide 23, so I'll give a story on how we increase value, because this is a good thing. I had a client in New Mexico come to me and said, I met with XYZ buyer and gave me an XYZ offer, and I really want to sell to them. And I know that I could get more money if you represented me and we go somewhere else, but I don't want to sell to somebody else. And I get that. There are reasons to maybe take less money to go work somewhere that you want to work and you really believe in. And so I'm not going to sit here and tell you that money trumps your feelings towards this buyer. And so we talked to the pros and cons in general of what it would mean. And I reviewed the offer from the buyer, and I told them, look, if you retain us, and I gave him our standard fee, I'll increase the offer by 30-some%. I believe it's possible based on what I could see. And we were able to do that and get that increase in valuation in a very short order and close the deal very quickly because we didn't have to run a marketing process. We had a deal up in the Northwest where a client had a similar story, had an LOI. He's like, I think this is a great offer. It was a good offer. It was a strong offer. And we were able to, and we said, but we can improve it. And we were able to work with him and he decided he wanted to go to market and talk to more buyers, and we increased his offer by 30-some%. So I had one recently that just the other day where somebody called me and they were about to sign a letter of intent, and I reviewed it, and same thing. I said, retain us. A couple of phone calls later, it was another 30%. So this happens pretty consistently, and because there's just so much that we know how to pull with as far as how the buyers value these businesses, and the buyers aren't being dishonest. They're just going to take very conservative views when someone like us is not in the mix to help them think through these things. Yeah, as far as what drives value, I mean, it's organic growth, it's owning the whole book. If you can't sell what you don't own, so if you have 1099 producers or agent, book ownership, that's all detractors of value. Younger age, if your average owner age or average producer age, average employee age is lower, that really helps. They want to make sure that the employees aren't going to, you don't have an aged workforce that is going to be an issue in the future. So there's ways to mitigate some of those things, and that's where we add a lot of value. Is how do we mitigate with the all this. There's a lot of things that go into valuation other than growth and profit. When we go through and position the business, there's a whole list of things that we're going to go through from a benchmarking perspective, and we're going to position to ensure that an agency we're presenting the lowest amount of risk to a buyer possible. So what a buyer's doing is when someone sells their agency to a buyer, they're selling the risk rate related to the cash flow of the agency to the buyer. And the buyer's underwriting that risk. And the riskier that feels to them, the lower the multiple is on that cash flow stream. So our job as advisors is to position our clients on all factors, whether that be average age, whether that be the contracts with their carriers, whether that be the contracts with their producers, whether it be the type of business they write. We're going to present that in the best possible light to mitigate the risk of the cash flow stream to the potential buyer so they can underwrite it at a more aggressive multiple as we're presenting the buyer. We call that positioning, and it's largely what we spend an enormous amount of time on in the first 4 to 6 weeks of retaining our clients. And many of our clients know a lot of these things that they've been part of our consulting services for a long time, at least at a high level. They know the kind of things that we care about and drive value. If there's no other questions, I really appreciate everyone's time. This will be recorded, so if other members of your organization would like to listen to it, they couldn't attend, where we can get them set up for that. This is my contact information. Happy to take the call or email anytime, and I hope you guys all have a great day. Thank you.